Hi, my name is Fatima Omarjee, an expert tutor in financial reporting, presenting to you this topic explainer video on revenue from contracts with customers. According to the FR syllabus, revenue is tested under accounting for transactions in financial statements. This topic is tested both in objective test questions and constructed response questions. Students would be required to determine revenue for the period with its related costs. Students are also required to present revenue, costs relating to revenue, and if applicable, any contract assets and liabilities in the financial statements. In order to prepare yourself adequately, it will be useful to use the following approach. Make sure you are familiar with the technical content. This section can be tricky, so you would need to spend sufficient time to get familiar with the underlying principles. Thankfully, ACCA has some great material to help you with this. Please make sure you use the technical articles and the above Study Hub resources to consolidate your knowledge. Once you are familiar with the technical content, you then need to do exam preparation. Since you are writing a computer-based exam, you must be familiar with the CBE tool, which can be found on the practice platform. Please make sure you do sufficient exam questions on this topic. Additionally, the Study Hub has a wide range of practice questions on this topic, which include objective test questions and constructed response questions, which are a great way to test your knowledge on the topic. The core principle of IFRS 15 is that an entity recognizes revenue from the transfer of goods or services to a customer in an amount that reflects the consideration that the entity expects to be entitled to in exchange for the goods or services. But when and how does an entity go about recognizing revenue? The standard has a 5-step approach to recognize revenue. We will unpack these 5 steps. The following background information will be used to unpack each of the 5 steps. Let us assume that a private school approaches a furniture manufacturer and wholesaler to supply the school with work desks and also for the entity to refurbish these desks after a 2-year period. Furthermore, the furniture manufacturer and the school sign a written contract that stipulates the contract price and payment terms. The contract also states the number of desks to be supplied together with the delivery date. And lastly, the terms and the date at which the refurbishment process must begin is also stated. The first step of the 5-step revenue recognition model requires an entity to identify contracts with customers. This requires that all of the above criteria need to be met. Take your time to read through these criteria as we will apply them in the next example. Based on the background information, can a contract be identified from the arrangement between the furniture manufacturer and the school? By signing the contract, both parties, that is the furniture manufacturer and the school, have approved the contract in writing. The contract stipulates that the furniture manufacturer must deliver 900 desks on 1 Jan X4 and the entity would need to refurbish these 900 desks beginning 1 Jan X6. Therefore, each party's rights can be identified. The payment term is cash on delivery for an amount of $100,000 on delivery date of the desks, which is stipulated and therefore is identified. The contract would give rise to cash flows from executing the contract and selling the desks and performing the refurbishment, and therefore has commercial substance. And lastly, it is probable that the entity will collect the consideration from the school since the payment term is cash on delivery and no evidence indicates otherwise. Therefore, since all the above criteria are met, a contract is identified. The second step of the revenue recognition approach is to identify performance obligations. A contract may either have multiple distinct performance obligations or a series of goods or services that are transferred in the same way, and that would be regarded as a single performance obligation. One would therefore need to analyze the nature of the contract carefully to ascertain if there are distinct performance obligations. If the obligations are not distinct, then it would be assumed to be a single performance obligation. A distinct performance obligation is one where both the customer can benefit from the good or service on its own, and the good or service is separately identified in the contract. Can you identify the performance obligations from the contract between the furniture manufacturer and the school? Since the desks will be delivered and will be used prior to the refurbishment, the desks are functional without the refurbishment. So, the customer can benefit from this good on its own. Additionally, the sale of desks and the refurbishment after 2 years are both separately identified in the contract. On this basis, there are two distinct performance obligations in the contract, one being the sale of desks and the second being the service to refurbish the desks. Step 3 is to determine the transaction price. The transaction price is not merely the stated amount to discharge a performance obligation in the contract. In determining the transaction price, factors such as the time value of money, the fair value of any non-cash consideration, estimates of variable consideration, and consideration payable to the customer must be taken into account. Assuming the contract only constituted of a performance obligation to deliver desks on 1 Jan X4, and the payment conditions stipulated that a payment of $65,000 would only be due on 1 Jan X6, 2 years after the date of delivery. What would the transaction price be if the present value of the consideration to deliver the desks were to be $60,000 on 1 Jan X4? Since the payment of the desks would take place 2 years after delivery and fulfilling the performance obligation, the contract contains a significant finance component, and this would need to be taken into account when determining the transaction price. The total consideration of $65,000 reflects both revenue from the sale of the desks as well as interest income. The revenue from the sale of the desks would be the present value of the $65,000, which is $60,000, whilst the interest income would be the difference between these two amounts, amounting to $5,000. Remember, interest income would need to be recognized using the effective interest method. Step 4 would be allocating the transaction price. When a contract has more than one performance obligation, the transaction price needs to be allocated correctly to each performance obligation. But how does one do that? Reference needs to be made to those performance obligations had they been discharged separately, and the transaction price would be allocated based on this proportion. According to the standard price list, a single desk supplied as per the contract would be sold for an amount of $100, and the price to refurbish a single desk is $10. The total transaction price is $100,000. What would the proportion of the desks in refurbishment be when allocating the transaction price? And what would the allocated transaction price be for each of the two performance obligations? The proportion of each component would simply be the proportion of that component in relation to the other as per the table. The total transaction price should now be allocated on the basis of the previous percentages to each performance obligation. Therefore, 91% of the total transaction price, amounting to $91,000, would relate to the sale of the desks, and 9% of the total transaction price would be allocated to the service component of the refurbishment and would amount to $9,000. The final step of this process is to recognize revenue. That is, when should revenue be recognized in the financial statements? This could either be at a single point in time or over a specific time period. But how exactly would we know if it should be recognized at a single point in time or over a specific time period? Revenue should be recognized at a single point in time if the customer obtains control of the asset. Some of the indicators to evidence control would be if the customer has an obligation to pay for an asset, if the customer has legal title to the asset, if the entity has transferred physical possession of the asset, the customer has the significant risks and rewards of ownership, or if the customer has accepted the asset. From the background information, when would revenue from the performance obligation to sell the desks be recognized? As per the background information, the revenue from the desks would be recognized at the point in time when delivery takes place on 1 Jan X4. This is because, according to the payment terms, the customer has an obligation to pay for the asset on this date. On delivery date, physical possession of the asset is transferred to the school. The significant risks and rewards of the ownership have also passed on this date, since the school will be using the desks from this point, and the customer would accept the asset at this date when the desks are delivered. Therefore, the customer obtains control, and revenue should be recognized at this date in the financial statements of the furniture manufacturer. On the other hand, a performance obligation is satisfied over time if one of the following criteria are met. The customer simultaneously receives and consumes the benefits of the goods or services while the obligation is performed. Performance creates or enhances an asset that the customer controls during that creation or enhancement, or if performance does not create an asset which the supplier has an alternative use for, and the supplier has an enforceable right to payment for performance completed to date. From the background information, would revenue from refurbishing the desks be recognized over time? The school simultaneously receives and consumes the benefit of the entity's performance in refurbishing each desk as and when each desk is refurbished. The fact that another entity will not need to perform the refurbishment of these desks to date also demonstrates that the school receives and consumes the benefits of the furniture manufacturer's performance. Therefore, revenue from refurbishing the desks will be recognized over time. Now that we understand when revenue must be recognized over time, the next question is, at what amount should revenue be recognized over the time period? For example, if revenue must be recognized over 2 financial year ends, how much of revenue should be recognized in the first financial year end, and how much should be recognized in the second financial year end? The standard discusses 2 methods of measurement that can be used, the outputs method or the inputs method. These methods provide a means of establishing the percentage of the total revenue relating to that performance obligation to be recognized over time at each year end. From the background information, assuming the entity has a 31 Jan year end and 300 of the 900 desks have been refurbished at 31 Jan X6. Calculate the revenue to be recognized if the entity has a policy of measuring revenue over time based on the units produced or delivered. Since the entity recognizes the revenue from refurbishing desks over time, a portion of the revenue from refurbishing the desks must be recognized at the 31 Jan X6 year end, and the other portion must be recognized at the 31 Jan X7 year end. Using the information from the previous illustrative example, the transaction price relating to the refurbishment amounts to $9,000, and this amount would need to be recognized between the two financial year ends. Using the units produced or developed basis to establish the portion of revenue to be recognized at year end, the work produced to date as a percentage of the total work to be produced would be 33%. 33% of the allocated transaction price of $9,000 will be $2,970, and this will be recorded as revenue at the 31 Jan X6 year end. The remaining revenue of $6,037 will be recognized during the 31 Jan X7 financial year end. Now that we have become familiar with recognizing revenue, which is an income, let us cover some basics relating to costs. Costs relating to contracts can be classified as either cost to obtain a contract or a cost to fulfill a contract. But how do we recognize these costs? When an entity incurs costs to obtain a contract, an entity needs to establish if those costs would have been incurred irrespective of actually obtaining that contract or not. If a cost is incurred only because a contract has been obtained, those costs are referred to as incremental costs in obtaining a contract and could either be recognized as an asset or an expense. However, if a cost is incurred despite obtaining a contract or not, then those costs are recognized in P&L when incurred. If an incremental cost is expected to be recovered from the customer, then the cost should be recognized as an asset. If not, the cost should be recognized as an expense in profit and loss when incurred. The following costs had been incurred by the furniture manufacturer prior to executing any of the performance obligations: tender application cost of $200 and legal fees to drop the contract of $800. Explain how each of these costs would have been treated. The tender cost is not an incremental cost, since this cost would have been incurred despite obtaining the contract or not. Therefore, the cost of $200 would have been expensed in profit and loss when it was incurred. The legal cost is an incremental cost because it had only been incurred due to the contract being obtained. Since it was not recoverable from the customer, it also would have been recorded as an expense in profit and loss when it was incurred. Finally, when a contract is obtained and when costs are incurred to fulfill that contract, those costs are either directly attributable to the contract or not. Direct costs are those costs such as direct materials, labor, and allocations of costs that relate to the contract. These costs are recorded as contract costs as they are incurred in profit and loss. Other non-attributable costs would be recorded in profit and loss as well as expenses when incurred. However, these expenses will not form part of the contract cost. Now let us examine how revenue and contract cost will be presented and disclosed. In an FR exam, you may be required to prepare a statement of profit or loss in which you categorize income and expenses correctly, or you may be required to identify within which category a specific item of income or expense is presented. Revenue must be disclosed as a separate line item in the statement of profit and loss. Since revenue is associated with normal trading, it should be presented in the operating category. Additionally, contract costs that should be recognized in profit and loss should also be presented in the operating category and should be disclosed either by nature or function. This brings us to the end of this topic explainer video on revenue from contracts with customers. I hope you found this video useful. Good luck.